have heard that business owners can pay their children through the business and potentially save taxes. And yes, that can be a legitimate tax strategy. But simply transferring money to your child and calling it wages doesn't make it deductible. Paying your children can be a legitimate tax strategy, but the work has to be real, the compensation has to be reasonable, and the rules have to fit your specific business structure. Hi, I'm Lisa Marie Odeja, CPA, EA, former federal government auditor, and advanced tax strategist. Here at Pinnacle Financial Services, we specialize in tax strategy for real estate investors. Now, today's strategy can also apply to certain profitable business owners. And one of the things I always tell clients is that a good tax strategy has to work not only on paper, but in the real world. That means the transaction actually has to happen, the documentation has to support it, and the tax treatment has to match the way your business is structured. Let's get started. So, can your child actually work for your business? The answer is yes. There is nothing inherently wrong with hiring your son or your daughter to perform legitimate services for your business. Depending on the business and your child's age, that might include things like organizing documents, scanning receipts, preparing mailings, photographing properties, helping with social media, organizing supplies, or performing basic administrative work. The important words are legitimate and age appropriate. If your 12-year-old is supposedly your chief financial officer making $60,000 a year, we may have a problem. That is not the strategy. The work has to be real, and the amount you pay has to make sense for the work that's being performed. So let's talk about where the tax benefit comes from. When your child performs legitimate services for the business, reasonable wages paid for those services may generally be deductible by the business. The child then has earned income. Now, that income doesn't magically disappear simply because it was paid to your child. But depending on how much the child earns and the child's overall tax situation, that income may be taxed very differently than it would have been if it had remained as additional taxable income to the parent. For example, suppose your teenager legitimately earns several $1,000s working in your business and has little or no other income. Because the child has the standard deduction available against earned income, there may be little or potentially no federal income tax on those wages, depending on the specific circumstances. Meanwhile, without the deductible wages, that amount may otherwise have remained part of the business income, which is ultimately taxed to you at your marginal tax rate. That is where potential planning opportunity begins. But notice what I said. The child has to earn the money. If you're already spending money on your child, there may be an opportunity to structure that differently by having your child perform legitimate work for the business. So, when properly implemented, this strategy may create several benefits. 1, it may create a business deduction. 2, it can give your child earned income. And 3, it may open the door to additional planning opportunities such as a Roth IRA. But business structure matters. Now, this is one of the most important distinctions in this strategy. If your child works for your sole proprietorship or for a partnership where each partner is a parent of the child, special federal payroll tax rules may apply. Generally, wages paid to a child under age 18 in this situation are not subject to Social Security and Medicare taxes, which are commonly referred to as FICA taxes. And wages paid to a child under age 21 generally are not subject to federal unemployment tax or FUTA. That can make this strategy particularly attractive in the right business structure. But suppose instead that your business is an S corporation. Now the rules are different. If your child works for a corporation, including a corporation owned by the child's parents, those wages generally do not receive those same family employment payroll tax exceptions. In other words, the wages are generally subject to FICA taxes. That doesn't mean that hiring your child through an S corporation is automatically a bad idea. It simply means that when you hear someone say, pay your kids through the business and avoid payroll taxes, that statement is incomplete because the business structure matters. This is where I see the difference between a strategy that sounds good on social media and one that can actually be defended. If you're going to use the strategy, the employment itself has to be legitimate, and you should be able to substantiate the work performed and the compensation paid. So, if you would normally pay someone $15 or $20 an hour to do a particular job, paying your child $150 an hour simply because you want a bigger deduction is going to be difficult to justify. You need to look at the work being performed, the child's age and abilities, the amount of time spent, and what someone else would reasonably earn performing the similar work. So, common sense matters here. So what about younger children? Well, there isn't one simple federal tax rule that says a child must reach a particular age before they can ever work in a family business. But the tax law is not the only law that applies. Federal and state labor laws also matter, particularly with younger children and certain types of work. So, I wouldn't hear this strategy online and immediately decide to put your 6-year-old on payroll tomorrow. The work still has to be appropriate, legitimate, and permitted under the applicable rules. As I mentioned earlier, there's another reason this strategy can be powerful. When your child legitimately earns wages, that child now has earned income. And earned income may create an opportunity to contribute to an IRA, including potentially a Roth IRA, subject to the normal contribution rules. Let's say your child legitimately earns $5,000 working in the business. Assuming the other requirements are satisfied, that earned income could potentially support a Roth IRA contribution of up to $5,000. Now, we're not just talking about reducing taxes today. We're potentially giving a young person decades for that money to grow inside a Roth IRA. And that is where tax planning and wealth building can start working together. Let's now put the strategy together. Suppose you own a profitable sole proprietorship and your 16-year-old legitimately works in the business during the summer. Assuming everything is properly handled, that $5,000 may generally be deductible compensation to the business. Because the child is under 18 and is working for the parent's sole proprietorship, those wages generally would not be subject to FICA taxes. And because the child is under 21, the wages generally would not be subject to FUTA either. Depending on the child's overall tax situation, there may be little or potentially no federal income tax on those wages, and the Roth contribution doesn't necessarily have to come directly from the child's paycheck to fund the Roth. A parent can help fund the Roth as long as the child has enough qualifying earned income to support the contribution. Guys, this is a legitimate tax strategy, but the important part is not simply that you paid your child $5,000. The child performed real work, the compensation was reasonable, and the business structure supported the tax treatment. Those are the facts that make the strategy defensible. So the better question is not simply, can I pay my child? The better question is, given my business structure, my family situation, and the actual work my child could perform, would hiring my child create a legitimate tax and wealth building opportunity? Sometimes the answer is yes. And sometimes the answer is no, because the administrative costs and the complexity may outweigh the tax benefit. And sometimes the way the business is structured changes the economics of the strategy. That's why I look at tax strategies as part of an overall picture rather than chasing individual tax tips. Tax preparation looks backwards. Tax planning looks forward. If you'd like professional help determining whether paying your children through your business or another tax strategy may be appropriate for your situation and help you legally reduce your tax liability and build wealth, scan the QR code on your screen or the link at the top of the description to schedule a discovery call with Pinnacle Financial Services. Now, during that call, we'll discuss your goals, your current situation, and how my firm works. From there, we'll determine whether we're a good fit to work together, and if we are, we'll discuss the next steps. Paying your children through your business can be a perfectly legitimate tax strategy. But like most good tax strategies, the details matter. The work needs to be real, the compensation needs to be reasonable, the records need to support it, and the tax treatment needs to fit the business structure. The best tax strategies aren't just effective, they're defensible. At the end of the day, it's not what you can take, it's what you can defend. Thanks for watching, and I'll see you in the next video.